Tommy Durfler, Sam Rice here, back on the Spotlight podcast. Coming to you from Franklin, Tennessee. The weather here is beautiful. It's that time of year. And so just glad to have everyone back. Appreciate you listening. And so today, what we're going to talk about are taxes in retirement. The interesting part about this is you do everything right. You plan for this day and you did everything you're supposed to do regarding saving money and the planning that's involved and get you to this point. And all of a sudden you get to this point and guess what? Uncle Sam knocks on your door and says, oh, wait a minute. You don't get to keep all of this retirement money. You didn't think that you could do that, could you? Of course not. And so, what we're going to partly talk about today are these hidden taxes that could really make retirement really annoying. Ones a lot of people don't plan for. Some of these, they just kind of sneak up on you, but not fun to think about. And so obviously with Lighthouse Wealth Group, what we do is we do financial planning that also takes this in consideration, because if you don't watch out, they can sneak up on you and just have another thorn in your side regarding retirement.
Yeah, but a lot of times people don't know about these taxes until they talk to an advisor and they hear about it the first time.
By that time, they're really annoyed, right?
Yeah.
And what we're going to do, this is somewhat timely. I know there's a lot of legislation out there right now that could change some of these things. We're not going to go into that. We're just going to talk about what is as of today. And so a lot of the changes could impact it in obviously a good way, but there's no way to know for sure since politicians control that. We don't. So the first tax we're going to talk about is Social Security taxes. What do you think about that one?
Did you know it was taxable? Most people don't. I swear most of the time when I bring up Social Security to clients or prospects, they have no idea that it's taxed at all. They assume it's not taxed. Mm-hmm. And I don't know if
because you pay into it
or similar conversations with folks. They're surprised.
I mean, you pay into it all these years and all of a sudden you can get it back. And it's like, wait a minute, I'm taxed when I get it back. That's not really that fun. And just to kind of give a little context to this, yes, you are essentially taxed on Social Security. Now, that depends, of course, on all these technical calculations that go into this. The way our tax system works is a little complicated as far as this goes, but you kind of have to look at different forms of income, and you have to include a portion of your Social Security benefit in that, and then it spits out basically based on certain provisional income. It'll say, okay, now that we know that, which isn't very much, by the way, but you can do these calculations and then it kind of spits out and tells you, okay, what percentage of your benefit is taxed. So for the sake of simplicity, there is situations where you won't be taxed on your Social Security benefit. And that is if your income's pretty low. So you have to have a pretty low income in order for your Social Security benefit not to be taxed. And I haven't seen too many people that have really been within that threshold for it not to be taxed. And then, of course, if you make over, and this is 2025 here numbers, if you make over $44,000 in your provisional income, that is when 85% of your Social Security benefit is taxed. So even though you are taxed, not 100% of it is exposed to taxes, but the majority of it is. And so,
even lower limits for if you're filing single, $34,000 in that case.
So, most of the time your Social Security benefit is going to be exposed to. And so, this includes required minimum distributions, pensions, these other things add to that. That'll determine how much of that Social Security benefit is taxed. So sorry, folks. Yes, Social Security is taxed most of the time for a lot of individuals. There's just no way around that. But there are things you can do to control those taxes in retirement to make sure you stay within a certain threshold. Sam, what's another tax that you get a lot or you have to pay attention to?
Yeah, and this one's a shocker for most people too, is that your Medicare premiums can change in regards to your income levels. So that's what determines your Medicare Part B premium once you transition to that at 65 is your income level. And so if your income
Hmm.
level changes, those premiums can change for better or for worse.
Yeah,
But another thing that people don't really think about.
100%. And it's tough because, you base that off of typically you have a 2-year look back. So
Mhm.
let's use this year an example, right? We're in the end of March, first quarter of 2025. So people are wrapping up doing their taxes. So let's say you're over this threshold, and now all of a sudden, Medicare premiums go up. And when they go up pretty significantly per month. And so
Yeah.
once you file your taxes, obviously that's when the government sees, oh, you're over this threshold. So now we're going to
Mhm.
start taxing your Medicare premium. I'm sorry, we're going to start increasing your Medicare premiums to a certain amount, and it can get pretty expensive. And these tax brackets are pretty wide. It's not, 3 tax brackets. It's more like
Yeah.
6.
It's about every 50,000 or so.
But it can get up there, and and so you're getting the same benefit. You're still getting the same Medicare um, coverage, but it's basically like saying, hey, you get the same product, but it's going to cost a lot more this time. So going back to
Right.
that 2-year look back, once you file 2024 taxes, the government says, okay, great, you are over this amount if you are, and now your Medicare premiums go up. So you have to go through 2025 and then 2026 as well,
Mhm.
because that's when 2027 is when you file your taxes, that even if you did go down, you would have to have filed that taxes. So it's a 2-year look back.
Yeah, it'd be
So,
nice if they were getting rid of that too.
mm-hmm.
Hopefully that's on the chopping block as things progress through legislation as well.
And so I know for, a lot of folks, Roth conversion can be a very advantageous thing, but keep in mind, once you do a Roth conversion, you go over a certain limit, that'll sneak up real quick on you to all of a sudden these Medicare premiums start to go up at a pretty substantial rate.
Yeah, definitely something you want to do before you hit that 65 age range so you're not doing conversions while this could affect that.
Now, I do believe there is a one-time exception to this. Obviously, people
Right.
have certain life events, but what were you going to say?
Yeah, I think, sometimes if people inherited a chunk of money or got a one-time lump distribution, I think you can exclude 1 year.
Yeah, you could say, hey, this is a one-time exception life event that happened, and you can file it with government, and they'll, in
Yeah.
some cases, they'll grant you that and say, okay, great, we understand that. I think you get one exemption per lifetime. So they do give a little bit in that regard if there's something that happened regarding that. Regarding again, kind of Roth conversions, that all counts towards that income. So you got to be really careful about that. And sometimes it's going to happen. In RMDs that can kick you up. Other than Roth conversions, the RM required minimum distributions that can kick you up in another bracket. And so sometimes there's just nothing you can really do about it. And in some cases, with thoughtful and careful planning, there are some things you can do to make sure that you stay within a certain bracket for Medicare premiums. But man, is it a sneaky one?
If you've got because Social Security counts as income towards that, if you've got a pension and if you've got RMDs all combining at once, you could be quite easily over that pretty easily, pretty quickly, and
Yeah,
not even realize it.
exactly. What we try to do is say, hey, we just don't want to expect any surprises.
And educate people, hey, what's your overall income looking like? Because people might not think about this, especially once they pull the plug. There's only, we can control income to some degree, but at the same time, people do have to live. So just letting people know that, hey, it looks like you might be crossing this barrier. We can do what we can to kind of mitigate this and pull from different account sources. That's one of the nice things, you know, one of the things that we do is, right, you've got different types of accounts, different types of income that they count towards this, and ways that we can kind of work around those limitation areas, just like your tax bracket in general.
We want to make sure to meet expectations to know what's coming around the corner. Nobody likes getting a big surprise, the first quarter of the year during tax times. The third hidden tax is pretty interesting because it's called the widow's tax. And I thought this is really interesting. And so the widow's tax is basically widow or widower is when one spouse passes away. And then, for 1 year, you get a surviving spouse tax bracket, which is different than married filing jointly and single tax filer. And this, which is still advantageous. But then the year after that, you go to a single filer. And which means that in a lot of cases, you could be receiving the same amount of income from different sources in retirement. And all of a sudden you go from married filing jointly, which has, greater thresholds as far as standard deduction and other benefits, to now going down to a single filer after 2 years. And now you're paying more because you're in a much lower tax bracket. The tax brackets start at a much lower level for the same percentage, if that makes sense.
Yeah, for the same income. I can't remember what it is off the top of my head, but yeah, it's like the jump from 12 to 22%, say for married filing jointly, could be 190,000. But if you're single, the jump from 12 to 22 could be 100,000. But you're still needing to live off, say, 150,000 in retirement or something like that. Boom, that's automatically going to blow up your tax bracket.
Same income, higher taxes. Talk about insult to injury on that one. And sometimes there's not much you can do about that. And I will say, as a CPA, it's not always a bad thing paying taxes. Yeah. It's not always a bad thing because it normally most of the time means you're making good money. We just want to limit the tax exposure as much as possible. So what else should people look for, Sam?
And this, I don't think, should completely control your retirement decisions, but being aware is definitely very helpful. Keeping aware of your state's tax, as opposed to some states that don't have state income tax, and how that could affect you. Florida is a retiree haven. They have no state income tax. I know that's one of the nice things about here too. When you see some people moving here from higher state income tax bracket states, say like New York or California or something of that nature, wanting to spend their retirement in a place that's much more advantageous to their tax rates, if they're going to be trying to pull out money as sparingly as possible because they're not in their income generating years anymore, and being as thoughtful as possible with their taxes.
I mean, you think of Texas, Tennessee, Florida, those are all states that do not have a state income tax. And a lot of times I've talked to a lot of people that have made decisions on where they're going to live based on a state income tax, because it's just giving unnecessary money, to the state. And if you can go and retire, that's why Florida is kind of the snowbird state. If you can go and retire there, it's warm weather, it's beautiful, it's near the beach and the coast. And at the same time, you're not getting or giving unnecessary money to the state.
And, they make up for it in other ways, right? You're probably going to have a higher sales tax, or maybe your property taxes might be a little bit higher. But I feel like a lot of people feel that they can control that easier than just a straight income tax on any money that they pull out. They're fine mitigating what they purchase if it's sales tax. I feel like that's a more attractive way to do it, potentially.
So go research which states have a friendly state income tax, or if any at all, and research that. But sometimes that'll be a big decision regarding where a lot of folks want to retire, is just where the state income taxes look like.
We had a client back a few years ago that moved to California, and from a income tax free state. So they had become accustomed to no state income tax for the majority of their life. And then I think their grandkids or their kids or something like that were in California, and they had on paper, prepared for a potential move like that. But once they actually got the final tax bill at the end of the year, and I think they had a pretty sizable portfolio and just the living expenses needed to draw the money out to live there, they were, needless to say, very shocked and surprised and not very happy each year with that. I think it increased their taxes 10 to 13%. So that can be a sizable chunk if you're pulling out, $200,000 to $300,000 a year out of a portfolio that used to be in a tax-free state.
Simply by just moving to another location.
So
So again, not
definitely
just
things moving down to states that are tax-free.
so. Now, another thing is, of course, we see this a lot, but talking about required minimum distributions. So what I love about this is, the Roth is relatively new, comparatively speaking. And so is just grown in popularity every single year because people see the benefits of going ahead and pay, Uncle Sam now and then putting it in a completely tax-free account so that, you shake hand with the government now, and then you'll never have to pay another dime to them again, which I think attracts a lot of people to doing this. Yeah. So, but, before these Roths existed, you only had these pre-tax accounts, things like IRAs, 401ks, simple IRA, SEPs, 403bs. And so, that was the only avenue really to put money in for retirement accounts a lot of times. And you do that and you get the tax deduction on the front side, right? You get the tax benefit typically on the front end when you put money in. And then that money accumulates. And then it's only after you decide to take it out after a certain age that it is now taxed. It's almost like getting your income, a paycheck. And so, what the government says is, okay, because we've never taxed you on this money, there's got to be a point where we settle up, we being the government, settle up with you, and you owe us our fair share of taxes. And that's typically in a retirement phase. So they have these complicated tax tables that basically show you how much you're supposed to take out each year, starting at a certain age. Obviously, those ages have changed the last couple of years, which I think is a good thing. But you do that, and now people, it's almost like, oh man, I'm in retirement and I'm still paying taxes out the wazoo. This isn't fun. And so it can spike your taxable income.
I think it's, depending on the tables, it's usually about maybe 2 to 4% of the portfolio value. And obviously, as the portfolio value changes, that number will change each year. So that's a predetermined number at the beginning of the year that gets calculated. So they're saying at least this amount of money needs to come out of your pre-tax portfolio. We're going to collect our taxes on it. No, that is one of the big beauties of the Roth, avoiding that.
And so if we talk about what we've talked about up to this point, required minimum distributions can now affect the Medicare premiums because that goes into that bucket of money determines how much you're going to pay in Medicare premiums. It also goes into the bucket that determines Social Security, how much of that benefit is exposed to tax liability. And then, it's just a situation where it can really creep up and affect different things. And that's what makes it a little bit more complicated. And so that's where, for people that are starting to accumulate pre-tax accounts and start accumulating a lot of money in those accounts, talking about a Roth conversion early on could really help reduce the amount that is going to be exposed to the taxes from your required minimum distribution. And so, looking at Roth conversions prior to retirement, of course, or just simply putting more money into a tax-free account is a way to help mitigate those taxes in retirement.
Yep, they've got Roth 401k options now, which offer the higher contribution limits than just a traditional Roth IRA, which is nice. So that's becoming way more popular as well. So you can start it at an earlier age.
And even if you have pre-tax, 401k accounts, you can start now converting those to Roth 401ks. They've added that if you have an employer match, that can be considered a Roth contribution to your account. So it really is, they're really heading in that direction of having more flexibility to really reduce those RMDs as much as possible. But for a lot of people, that's just what they saved in over 30, 40 years. Yeah, we always get comments of like, wait, you're telling me that's taxable? It's like, yeah, it's taxable. But the other way to really mitigate that is doing what's called a qualified charitable distribution. So, and I won't go into the technical intricacies of these, but essentially what you can do is instead of taking that required minimum distribution and it being taxable to you, you can actually give it away and have it go directly from your account to a 501c3 organization.
Then it doesn't get tacked onto the top of your taxable income, which could affect your Medicare premiums, your overall tax bracket, that kind of thing. So we see that pretty common, don't you?
So it's a great way, if people are very charitably inclined, they can take that and say, you know what, we truly don't need the money. And it's not an all or nothing situation. If they want to give a portion of that, whatever portion of that required minimum distribution they have, they can start giving a portion away, whether it's 50% of it, whether it's a quarter of it. It's not an all or none deal, which really gives people a lot of flexibility to control that tax mitigation.
We see that pretty common each year, I would say, where we have to start telling people to spend money. I know you don't pull out of this account because you're really frugal, but you got to pull at least this much out. So we can either charity donate it, or, we can make a distribution into your bank account.
That's exactly right. And those RMDs can also have an effect on the ACA cliff for healthcare. Mm-hmm. You want to talk about that a little bit?
So if you're retiring prior to 65, when you get on Medicare and you start looking at the open market for health insurance as an independent policy or a joint policy with a spouse, there are certain subsidies and credits that are available to you under certain income thresholds. So why this comes into play is because on the independent market, health insurance can get very expensive, but if you've got some of these subsidies, that can help in a great deal. But depending on what your income level is and how you're mitigating that with different accounts over your overall, taxable income profile throughout the year, one of the situations we were thinking of is, if we were to educate a client on Roth conversions and we recommend that they do that, how is that going to affect their ACA
subsidy amount
insurance? Is it going to put you over that threshold where you lose all of your subsidies, where it's not really a tiered approach? It's just you're either over the limit and you lose it all, or you stay below it and you receive it. So dancing that fine line with income is definitely hard to do before you've got 65 rolling around and you can get on Medicare.
I mean, because people are relying on that subsidy, but the ACA health plan does have certain thresholds, and that can really throw a wrench at things, because now you're paying a cost that you were having before. Again, it's the same product, but much higher cost. And so things like Roth conversions, that can mess that up. Things like capital gains, those things can mess that up. All these hidden income streams that are probably behind the scenes a little bit more passive in nature creep up, and that can have a pretty significant
effect on the subsidies,
substantial effect on that subsidy amount. And so, of course, what we do is, we want to look at everything from a comprehensive financial standpoint. And so that's why we develop relationships with CPAs that can help us figure that out, to make sure, again, the goal for this is no tax surprises once April comes around every year.
Yeah.
But I think you said it very well. And, that is a hidden cost for a lot of people that have done well and that want to retire prior to 65, but still need a health insurance plan.
Yes. Do you find a trend with all of these hidden taxes? They are Social Security and health related. And it's all related back to a balancing act between these taxable income thresholds that really are able to give you benefits or count against you in retirement to some of these hidden costs and hidden taxes.
Mm-hmm. And then I think the final one that we see, obviously we see this more often than not, just because we're in this world a little bit more, but the net investment income tax. So, again, this is another gift from the government, the sarcasm, of course, but once you make over a certain threshold, now you owe a 3.8% tax on certain investment income. things like capital gains, dividends, trust income, rental income. So just for making over a certain amount, you are now taxed another 3.8% based on, those levels of income where you're based on those level of income streams and where your level of income is.
Yeah, mainly on capital gains. So you've got long and short-term capital gains, and this adds another 3.8% to those amounts that are already there.
So a
Lovely.
lot of times you can even have a capital gain rate of 23.8%.
Yep.
For long-term capital gains, everybody says, oh, that's 20%. It could actually be 23.8% once you add that net investment income to it. These are all things that at Lighthouse Wealth Group, we want to make sure our clients are aware of. You said it's really a balancing act. Paying taxes is not something we enjoy doing, but it also kind of says, hey, you're making good income. And so, what we tell people is, you never want to disregard paying taxes, because normally when you're doing that, you're usually having something that's going right financially for you. So we're just trying to limit that and create efficiencies with making sure we're efficient and how we're paying those taxes. And so that's why we work with a lot of CPAs and tax preparers and tax accountant, just because we want to make sure and get in these gritty details. And again, the whole point of this is just to get to April and say, hey, you're going to have to pay what you're going to have to pay. We just don't want there to be any surprises. And that's the hard thing that I think both of us have heard in a lot of client meetings, like, oh, I wasn't expecting that. And at the end of the day, you'd have to pay it anyway. But if we can kind of help ease you into those expectations, say, hey, listen, you sold a rental home. Hey, you sold a business. Hey, you sold this. These are going to create some taxes. It's been a big year in the market. You're going to have capital gains. We've got to make sure that
they're like, oh, we're going to get hit with some capital gains this year. They get annoyed, but hey, it's a good problem to have.
So as you can see here, there's certainly a lot of hidden taxes, especially for retirees. And that's the hard part about this, is you get to this point and you're like, all right, I'm really ready to sail into the sunsets and have, the greatest years of my life here. And if you don't watch out, these things can really creep up on you. So
that's right. So plan accordingly. Talk with an expert, CPA, financial advisor. Make sure you've dotted all your I's, crossed your T's, got everything in order, and know what to expect from these things when you start to make that transition and pull the plug for retirement. So you can enjoy these years.
So if we can offer a free financial audit, free second opinion here at Lighthouse Wealth Group, we'd be glad to do that. Please reach out to us, 629-654-7190. Please like and subscribe to our podcast, social media. We're on Instagram, Facebook, LinkedIn, all the social webs. But if there's anything we can help with, of course, let us know. And until then, we will see you next time. Thanks.
I'll see you then.